remember those days when we thought that mortgage securities would get our companies rich? Man, my company's broke now.
Yeah, but I heard there's a program out there to help companies get their troubled assets off their balance sheets.
Yeah, actually I heard about this program called PPIP. It stands for Public-Private Investment Program, and it basically aligns public and private interests to create a market for these assets and put a price on them.
And this program is aligned with the Financial Stability Plan, and it's actually divided into two parts. One is the Legacy Loans Program, and the other one is the Legacy Securities Program.
That sounds cool, but what exactly is it, and how is that exactly going to help us?
The Legacy Loans Program aims to remove toxic assets from banks' balance sheets by stimulating private demand for them. They will approach the FDIC with toxic securities that they want to get rid of.
The FDIC will then offer leverage of 6-to-1 debt-to-equity ratio on these pools of mortgage-backed securities.
And then the FDIC will help them by conducting auctions to sell off those equities.
The winning bid determines the price that the selling bank receives for its assets, and a public-private investment fund is formed to purchase the assets at this price.
Now, a portion of the equity is split between the treasury and the winning firm, and the remaining of that portion is now guaranteed by the FDIC.
After this has all been agreed upon, the investment firm with the winning bid is left to manage the public-private investment fund.
This is a demonstration of the Legacy Loans Program.
So I have this pool of mortgages with a $100 face value that I would like to cleanse my balance sheet of.
Okay.
May I sell it to the Legacy Loans Program, please?
Yes, we have analyzed your loans and we've determined that they are eligible assets for purchase through auction.
We are now going to go from the Capitol to the auction house. The FDIC will now conduct an auction to sell off these pools of loans to qualified private investors. The highest bidding price will determine the price of the loans.
So we have Oxford mortgage securities, and the original face value was $100, but we are starting the bid at $50. $50?
50.
All right, we have 50. Anyone have 60?
I'll do 60.
60. Anyone have 70?
84.
Oh, okay, 84. Anyone have 90?
No thanks.
84 going once, going twice. Sold! Yes, Oxford Bank. Do you accept the price of $84 for your loans?
Yeah, that sounds good.
All right, great. Bye-bye.
We are now walking from the auction house to the Department of the Treasury.
Alright, so this is how it's going to work. The winning bid was $84, which is the price of these assets right now. Of this $84, one part will be equity, and that will be $12, and 6 parts are debt, and that's $72.
I will split this $12 equity portion. There you go.
Okay, so my investment firm will put in $6 of the equity, and you will put in $6, so it will be a 50-50 split.
Exactly.
And I contribute the $72 of debt. Alright, so you will be in charge of managing these assets until final liquidation. In the meantime, the FDIC will provide oversight, and this in turn creates the Public-Private Investment Fund.
Well, okay, I guess the Legacy Loans Program kind of makes sense, but what is this Legacy Securities Program you're talking about?
Yeah, and what if the banks don't approach the government with their toxic assets?
Well, now let's all take a look at this legacy securities program.
The Legacy Securities Program starts with an application process to find qualified fund managers to run the public-private investment funds.
The fund manager is selected and given a 1-for-1 match for every dollar the fund manager raises.
The Treasury then provides 50% of the equity.
And then the Treasury can also provide a loan for the public-private investment fund for up to 2 times the original investment of the private firm. Reviewed your application and we approve you as fund manager of a public-private investment fund. You will be given time to raise a certain amount of private equity towards this investment fund, and we will match that in public equity.
Well, so far I've raised $100 million in private capital.
Okay, so we will match that in $100 million of public capital.
Well, the thing is, I think I will need more capital for my investment fund.
Okay, well, we can provide you a loan of up to 2 times the amount of private capital you've raised, which means you can ultimately receive a $200 million loan.
Okay, so if I do accept that $200 million loan, I will ultimately have $400 million of total capital to pretty much purchase toxic assets, correct?
Yes. And we expect you to purchase eligible assets, which are non-agency residential mortgage-backed securities and commercial mortgage-backed securities issued prior to 2009 and received a AAA rating at origination. You will also have full discretion in investment decisions.
Well, what if I need more capital for my investment fund?
Well, you may also be eligible for additional loans from the expanded FAS Term Asset-Backed Securities Loan Facility Program, which is the TALF.
Hey, I heard you were talking about PIP.
Yeah. Well, pretty much we were just talking about the programs and all. I get it, but ultimately, my question is ultimately what is going to happen to these investment funds and governments holding these assets?
Well, if this program performs well, then everyone wins. The government gets money and the investors get the money. But if the program doesn't perform that well, then, the government would absorb the majority of the losses.
Well, that's true, but I mean, how are we supposed to price these assets without this program? Yeah, see, we don't really know how it's going to be yet. We'll have to wait and see the results.